Hey, welcome to The Market Investor. I'm Daniel Snyder. Thank you so much for checking out this video. This is a topic that I think no one really talks about, but they should, especially for any type of investor, any type of trader. It's something that can completely blow up your portfolio if you're not careful. It's taxes, man. We all hate them, but we got to pay them. They suck. I think they suck. You think they suck. Everybody hates taxes, but we got to know short-term capital gains tax versus long-term capital gains tax. We'll get into it right after the intro. Here it is. All right, so without further ado, short-term capital gains tax, man. This is something where you buy an asset and you sell the asset under the period of a year. A year is what the government deems a long enough time, a short enough time, however you want to look at it. That's the timeline. And that's really the border that you need to know. If you buy something and sell something within the period of a year, whatever you made in profits is what is taxed. We're talking stocks, we're talking land, we're talking buildings, we're talking bonds, we're talking options, we're talking futures, we're talking Forex. I mean, anything that you buy and sell and make a profit, that is a security, is taxed as a short-term capital gains tax if it's under 1 year. What is the tax? That is the key question. What is the tax? What is the percentage of the profits, not the entire cost of the profits? What is the percentage of the profits that is taxed? And what is that number? Well, for short-term capital gains tax, it matches up to your ordinary tax income bracket. So it could be 10%, it could be 22, 24, 35, 37, or 32. I mean, it just depends. So I'll throw up the graphic right here. And this is for individuals, but if you make between $39,476 to $84,200, you're going to fall within the 22% income tax bracket. And that's going to correlate to your capital gains tax of your short-term buy and sell of an asset, of a security as well. So you got to keep that in mind. So say for the year you have 22% personal income tax. That number is what's going to correlate directly to your profits of your security. So at the end of the year, now remember as well, when you sell the security, say you sell the shares of stock, you make the profit, they're not going to take the taxes out immediately. It's not like you're getting paid by an employer. They're not going to take the taxes out of your paycheck before they give it to you. They're going to give you the full amount of the sale. And it's going to be up to you at the end of the year when you have to file your taxes for the next year to put the securities into your file of your return to the IRS and say, hey, I made this much money through selling this security. Here's the profits. Here's the tax amount for my personal income. And this is how much I have to pay you for making the money on this security that I sold. So why do we like long-term capital gains tax? It's because it can be 0%. It can be 15% or 20%. That is less than anything, 22, 32, 35, 37. That is a less amount that you're going to be paying in taxes to the government just for buying and selling your shares of stock, your land, your building, whatever it is. Long-term capital gains tax, cross over that 1 year threshold. I don't care if it's 1 year and 1 day. Get past that 1 year threshold and you will save yourself so much money that you have to pay into the government over the long term. I mean, this is just like the number one thing that people need to know. They need to know the difference between short-term and long-term capital gains tax. This can blow up your portfolio if you're not careful. If you're growing and you're growing and you're losing and you're growing throughout the year and you're day trading, and then at the end of the year, the IRS is like, hey, you owe us $30,000 for all the profits you made. And you go, well, my account has $30,000 left right now. And they're like, well, liquidate it and give us what we're owed. You don't want to get stuck in that scenario. So you want to think ahead of going, okay, well, this is my play. You really want to think out your plays. You want to go, okay, well, I'm going to buy into ExxonMobil right now, even though it's so cheap, but there's an oil war going on. But I think in a year's time, it's definitely going to be at least $50 a share, if not $70 a share. I mean, whatever your speculation is, you want to do your due diligence. You want to have your exit strategy before you even buy into that stock or before you buy that house. You want to say, okay, well, I'm going to live in this house for 10 years. And if I move out, then it's become a rental property and it's going to bring in new income and that'll be taxed, the whole thing. But you want to think about it. You want to think about it before you ever even buy, sell, get into the property, get into the contract, get into whatever it is. And that's all it really is. I mean, just understanding that short-term personal income tax bracket, long-term cheaper taxes, and that's just the way of capitalism. Really, I guess, I mean, I didn't really think I was going to close it out, but that's capitalism, and that's how the U.S. government decides that, well, that's how IRS decided that we need to be taxed throughout making profits in the market. But that's all I have. I hope you guys learned something new. I hope you really will think about this before you get into investing or day trading, or if you're in the middle of it already, keep that in mind, because those taxes will add up throughout the year and really sneak up on you. So be careful. The IRS is always lurking. But that's all I got. I hope you'll subscribe. I hope you leave a comment below. If you got any questions, let me know. And I'll see you in the next video.